It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast on another weekend. Yes, it has landed. It's real estate all the way across our weekend with non-stop marathon of suburb by suburb, breaking down all of the numbers and the trends every morning on the Australian real estate market. A Saturday morning, July the 19th. Boy, this month is going by pretty quickly. Now, you may remember we were talking about Bitcoin with Jeremy there in Brisbane yesterday morning. We should mention that it has hit an all-time high in Australian dollars, reaching 175,000 per token, as reported by PropTrack. While crypto has its moments, experts say that now might be the perfect time to convert digital gains into something more tangible, i.e., they're saying property. Other commentators warn that Bitcoin offers big returns but also big risks, while real estate provides income stability and long-term growth. For many Aussies, bricks and mortar still wins the long game. And me personally, yes, bricks and mortar any day of the week, but Bitcoin will become more and more part of the real estate market given its level of appeal, and that is despite its extreme lows with its extreme highs. But what about you? Are you trading in Bitcoin? Have you made gains that have allowed you to not only buy a property, but maybe buy a property outright without any mortgage? Well, let us know if that is the case, or indeed if you know somebody that is in that space. Our email address is myrealestatepodcast@gmail.com. Let's right now catch up with Anthony Landahl, the Managing Director and Mortgage Broker at Equilibria Finance. Good morning to you, Anthony. I feel like in 2025, we need probably a new expression instead of bricks and mortar. Maybe like an example being the equity engine, because it does sound a little bit old school, doesn't it?
Does sound a little bit old school, and good morning, nice to be here. Look, I'm with you a little bit around the bricks and mortar as an asset class, but it's all about your risk profile, and Bitcoin has certainly attracted a lot of the younger generation. In fact, we've had clients who've managed to pay for deposits or part of their house through some of the gains they've made in Bitcoin. So I guess it's all about your risk profile, but bricks and mortar for me, I'm with you there, Craig.
And in recent years, the pressures of rising living costs, higher interest rates, and relentless growth in property prices, it has left many Australians wondering, is property still worth it for them? You know, the dream of owning a home has slipped further and further away, out of reach, and with it, the motivation to invest in real estate in the first place. So, Anthony, property has long been in the heart of Australia's wealth creation. For many Australians, owning an investment property has been their primary path to building financial security. So why do you think property has played, such a central role in personal wealth building and creation?
Yeah, really good question and very relevant for our times with housing affordability being such a challenge. But 2.2 million Australians own an investment property, and 70% own one investment property. 30% own more than one is the flip side. So that's 20% of taxpayers own an investment property. Part of the reason investment properties have been such an attractive part of a wealth accumulation strategy has been the accessibility. We hear the word leverage. What does leverage actually mean? Leverage actually means you are able to utilise a home as an asset to borrow against to help buy into an investment property and get the benefit of that capital growth through the investment properties. Historically, interest rates, the cost of borrowing's been fairly low. We've been able to use our home as another asset to leverage into an investment property. Property's been very, very accessible for investors to leverage into, to then buy a property, hold it for the long term and let it grow. Australian property's grown on average around 8 to 9% per annum over the last 30 years. So it does remain, if you can ride out the ups and downs, it does remain a good, strong asset class to invest in.
Yeah, and when comparing property to other asset classes, like we have been discussing crypto or shares and bonds, it does really stack up in terms of performance, risk and long-term value. I mean, we were talking to Jeremy yesterday. He was talking about crypto, saying that he invested a few years ago, bought crypto, I think he said $750 he paid for some of it, and that has turned into $100,000. But, you know, without all of those wild ups and downs like crypto, as you say, real estate, long-term value.
In any asset class, there is an element of timing the market. And there's that old saying, it's about time in the market, not timing the market. There are examples in any asset class, whether it's crypto, whether it's property, whether it's shares, where you get the timing right. But fundamentally, if you invest in an asset class, have the ability to hold the asset, whether it's shares or property, they have both performed very strongly. For example, over the last 5 years since COVID, we've had growth in Adelaide and Brisbane of over 80% in property as an asset class. The ASX grew about 70% in that same time frame. So it is arguable that in some areas of the property market, it's outperformed the ASX. Sydney's grown 40%. A lot of it depends on, yes, the time you get in the market. But I think for property and shares, if we look at them as an asset class, there's a never-ending debate about which one performs better. A lot of it is around getting into the market. Obviously, timing's important, trying not to buy at the top of the market, but being in there, but having the ability to then hold the asset over time. As I said, over the last 30 years, property's grown on average about 8.2% per annum. That's fundamentally a good investment if you compare it to holding cash. Term deposit rates are now 2, 3, 4%. Bonds might be 3, 4, 5%. Property, 8% over 30 years. That's not a bad investment in terms of year-on-year growth.
It is the Saturday Morning Property Show. We are talking with Anthony Landahl all about how you should be investing your money. When we come back, we're going to talk about the current landscape and also some of the core principles of property investing. So we'll talk about all of that next.
Every morning from 6 a.m, we bring you the latest real estate news with diverse perspectives from leading industry experts. We deliver the most property podcasts across Australia every week. From the emotion of property, the economic inflation, managing your expectations, lack of stock, price growth, construction appetite, days on the market. Stay informed with us and know your property.
And it is the weekend Real Estate Saturday, looking at the current landscape with Anthony Landahl, with those higher interest rates, tighter lending conditions and affordability pressures. Many investors, fair to say, Anthony, have faced significant challenges. When it comes to the younger generation, they're asking themselves, is the long-term value still holding firm enough to carry on getting into the property market? So what do you say to all of that?
It's a really good question. And the way we approach that answer is to look at two aspects to it. The capital growth. What I mean by that is, what's the growth of the property over time in a specific area, for example, that you might be looking at investing in? Is the average capital growth 8%, a number we touched on before? If that's the case, then you're looking at holding a property for a period of time with the capital growth. So fundamentally, we got a chronic shortfall in supply in Australian property. We got good rental yields. We got a shortage of housing. So if you've got the ability to hold a property over time, then yes, it is still fundamentally a good investment. The big challenge in the last couple of years has been the cash flow. What I mean by cash flow is the ability to hold the property. With higher interest rates, higher costs to hold the property around maintenance, around taxes, a lot of property investors have had cash flow challenges where, even though the rental markets have been tight, we've had strong rental returns, the rental yields are not covering the cost to hold the property, creating a cash flow shortfalls. Cash flow's really been the challenge in the last couple of years, aside from any negative gearing tax benefit you might get. So the big challenge has been, am I able to hold the property? What's my budget for managing this property? The income against expenses. If you can manage that, understand that, and manage the cash flow, the capital growth is, the fundamentals are still there for property investment.
Now, many are going to ask this question, and that is, do the core principles of property investing still apply to younger investors in this current market? Like, are strategies for buying long-term still appealing to younger generations, choosing like the right location that you're talking about? Also, leveraging equity. Is it still just as relevant in 2025 as it was in past decades? And that's kind of the little carrot, if you like, that has to sort of carry on in that breakthrough of, yes, property still is worth the investing.
Yeah, I'll deal with the second part of that question first. And is leverage still relevant? Absolutely. Leverage is one of the big benefits of property investment to enable people to get into that asset class. Shares, other assets don't have the ability to use leverage, to use equity to get into property investment. So yes, that's still very relevant. The core fundamentals of investing in property do remain true. And one of the biggest ones we talk to our clients about is take the emotion out of it. Look at it as purely an investment. You're investing your money. Do you invest it in the bank? Do you invest it in a term deposit? Do you put it in bonds, shares, or property? So approach it as a long-term investment for your wealth accumulation. That puts a different lens on how you're approaching it. You're not living in that property. It's purely then about what's the profile of this investment from a capital growth perspective and from a yield or cash flow perspective. Once you've taken the emotion out, you're then looking at the core fundamentals of the investment. So in this case with property, state by state, then you're breaking it down into particular regions and suburbs. The aspects you're looking at when you're comparing different areas or different potential investments is what's the capital growth been in this area over the last 5, 10 or 20 years? What's the infrastructure like? Is it going to attract renters? Is it an itinerant area that people come and go, or has it got the good core fundamentals of people who need rental properties? So what's the profile of the suburb? What's the profile of the property to attract both capital growth and rental yield? And then it's about getting your strategy right. We touched on it before. The core fundamentals of property investment still ring true around those different aspects for whether it's a younger investor, someone looking at their second or third or fourth investment property.
All right. Well, there's the take on our Saturday morning from Anthony Landahl. If you are a younger person thinking about investing long term, there is the argument for real estate. Have a great weekend, Anthony, and look forward to chatting again in a couple of weeks' time on the Saturday morning property market update.
Thanks very much, Craig. Look forward to seeing you again in a couple of weeks.
Explore new property destinations where you could live with exclusive interviews covering real estate news and market insights.
What would you do if you were Ross in that situation?
So I'd be sticking with Ross and saying, hey, his bond with his daughter's never going to change. The girlfriend may change over time. So either have a rock solid contract or just say, he can give his money to the daughter. The girlfriend can rent perhaps until that situation changes.
It's easy to take the money, especially from parents. It's not so easy to say, Dad, I love you. I love the fact that you're going to put some money in, but I don't want as much money as you're prepared to put in for me to become this sole owner of the property. I mean, it's very unusual. Maybe it's not. It's just unusual to my ear.
That's a great thing. But, maybe Ross could be the co-owner of the property until such a time as she's got the finance or the equity to buy him out. And just look at all the things that can possibly happen. There's all sorts of things, and the lawyer's the best person to look at every single scenario and plug all those leaks before they occur.
We connect you to the best real estate information across Australia. The Real Estate Podcast.